Are you worried about the possibility of another market crash? It's understandable to feel uneasy about the stock market, especially given the events of the past year. But the truth is, market crashes have been happening throughout history. They are often driven by similar factors. Hello and welcome to my channel. Today we'll be discussing one of the most significant events that have affected the financial world: market crashes. Market crashes are often associated with economic downturns, financial crises, and significant losses for investors, making them a topic of great interest and concern. In this video, we'll take a closer look at some of the most significant market crashes in history and discuss the factors that led to their occurrence. We'll also examine whether we're currently experiencing another market crash and what we can learn from the past to better navigate the present and future of financial markets. But before we dive into the topic, let's first define what a market crash is. In simple terms, a market crash occurs when the stock market or other financial markets experience a sudden and significant decline in value, often leading to panic selling, investor losses, and economic downturns. Understanding market crashes is essential for investors, economists, and anyone interested in finance. By examining past market crashes and their causes, we can gain insights into the economic, political, and social factors that shape financial markets. We can also learn how to better respond to market crashes and prevent future financial crises. So, whether you're a seasoned investor or just starting, this video will provide valuable information on the most significant market crashes in history and whether we're currently experiencing another. So without further ado, let's begin our journey through the history of market crashes. One of the earliest recorded market crashes occurred in 1720 with the South Sea Bubble. This crisis resulted from a speculative frenzy surrounding the trading of shares of the South Sea Company, a British joint stock company. The stock's value soared and many investors borrowed money to buy shares, leading to a sudden collapse and massive financial loss. Another significant market crash occurred in 1929 with the Wall Street crash, which marked the beginning of the Great Depression. The crash was caused by an economic boom followed by a sharp drop in stock prices, leading to a panic sell-off and economic recession. In 1987, the world witnessed the Black Monday market crash, where the US stock market dropped by over 22% in a single day. This crash was caused by investor panic and program trading, which resulted in an uncontrolled market decline. The dot-com bubble burst in 2000 was another significant market crash, which occurred due to the overvaluation of tech companies in the late 1990s. The crash resulted in significant losses for investors, but the economy recovered relatively quickly. The global financial crisis of 2008 was one of the worst market crashes in modern history, which was caused by the collapse of the US housing market and the subsequent subprime mortgage crisis. This crash resulted in a global economic recession and highlighted the interconnectedness of the global financial system. Each of these market crashes was unique in its own way, but they all shared similar characteristics. They were all caused by a combination of economic, political, and social factors that led to significant declines in financial markets. Understanding these factors can help us better prepare for potential market crashes in the future. Now that we have explored some of the most significant market crashes in history, let's take a closer look at the factors that lead to these crashes. One of the key factors that contribute to market crashes is economic conditions. A weak economy with high unemployment rates and low GDP growth can lead to a decline in investor confidence and a sell-off of stocks. Additionally, inflation, currency devaluation, and changes in interest rates can all affect market performance. Government policies also play a role in market crashes. Policies that encourage risky investments or have a negative impact on the economy can lead to market crashes. For example, policies that encourage deregulation, increase government debt, or encourage excessive lending can contribute to economic instability. Investor sentiment is another important factor that contributes to market crashes. Fear and panic can lead to a sell-off of stocks and a sharp decline in market values. On the other hand, overconfidence and speculative investment behavior can lead to overvaluation of stocks and a subsequent market crash. Finally, global events such as wars, natural disasters, and pandemics can also contribute to market crashes. These events can disrupt global supply chains, affect economic performance, and cause investor uncertainty. Understanding these factors is essential for investors and policymakers to navigate financial markets successfully. By analysing economic indicators, monitoring government policies, and considering global events, investors can make informed decisions that minimize risk and maximize returns. So, are we expecting another market crash? Given the recent volatility in financial markets, it's natural to wonder if we're currently experiencing another market crash. While nobody can predict the future with certainty, it's essential to analyze economic indicators to gain a better understanding of market performance. The good news is that despite some fluctuations, the overall trend of the stock market has been positive in recent years. In fact, the S&P 500 has seen significant gains over the past year, indicating a strong recovery from the pandemic-induced economic downturn. However, it's important to note that market crashes can happen suddenly and unexpectedly. Economic conditions, government policies, and global events can all contribute to a decline in market values. As such, it's crucial for investors to remain vigilant and take steps to protect their investments. One of the best strategies for safeguarding your investments during a market crash is diversification. Investing in a variety of stocks, bonds, and other assets can help spread out the risk and minimize the impact of a single stock or asset losing value. Additionally, investors should avoid making impulsive decisions during times of market volatility. Panic selling can lead to significant financial losses, and buying high and selling low is a surefire way to lose money in the long run. Lastly, while it's impossible to predict the future of financial markets, investors can take steps to minimize risk and protect their investments during times of market volatility. By diversifying your portfolio and avoiding impulsive decisions, you can weather the storm of a potential market crash and come out stronger on the other side. One of the most important things investors can do to prepare for future market crashes is to learn from the past. By examining the causes and effects of previous market crashes, we can gain valuable insights that can help us better make investment decisions. For example, the 2008 financial crisis was caused in part by risky lending practices and the proliferation of subprime mortgages. By studying this event, investors can better understand the dangers of excessive borrowing and the importance of responsible lending practices. Similarly, the dot-com bubble of the late 1990s and early 2000s serves as a cautionary tale about the dangers of speculative investing. Many investors poured money into tech stocks with little regard for their underlying fundamentals, resulting in a market crash that wiped out billions of dollars in wealth. By learning from these and other past market crashes, investors can identify warning signs and take steps to protect their investments. They can also develop strategies for capitalizing on market downturns, such as buying stocks at a discount or shorting overvalued stocks. Furthermore, policymakers can also learn from the past market crashes to improve regulations and policies that can help prevent future crashes. For example, following the 2008 financial crisis, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed to increase oversight of financial institutions and improve consumer protection. That's all for today's video on market crashes. Thank you for watching, and if you found this video helpful, please like and subscribe for more informative content. If you have any questions or comments, feel free to leave them below.